the longest winning streak for the S&P in over 20 years. And bond yields are up. Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekly update. So markets ended the week in an almost jubilant mood after the main equity indices seemed to have recovered from their tariff-induced turbulence post-April 2nd, also known as Liberation Day. But not everyone is so sure that we've really left this year's market volatility behind us for good, or whether this is just a short reprieve. So, with that in mind, here are the three topics that we'll be covering in today's video. 1. Equity markets are back up, but will they stay stable? 2. Which treasuries rose the most, and which ones fell this past week? And 3. What are the expected yields on the upcoming week's treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? And in this section, we'll have a special CD promotion that may be of interest to some of you who live in North Carolina. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Equity markets are back up, but will they stay stable? So, equity markets seem to be back to normal almost exactly a month after President Trump announced his new tariffs on April 2nd. The S&P 500 closed this past Friday at 5,686.67, slightly up from the 5,633.07 at the close of April 1st, the day before Liberation Day. In fact, according to MarketWatch, the S&P 500 index rose a 9th straight day, its longest winning streak since November 2004. And the tech-heavy and often more volatile NASDAQ 100 closed Friday at 20,195.25 points, up even 3% from its April 1st closing of 19,604.5 points. And to complete the picture, bond yields have mostly stabilized as well after the April volatility, with yields up a bit at the long end versus where they stood at the beginning of the month. But more about this later on when we talk about treasuries in greater detail as usual. So what's going on in the markets? Is all good again now? Well, in our mind, the broader market stabilization and recovery this past week was driven primarily by three factors. 1. There appears to be no immediate urgency for rate cuts based on the latest economic data. Even though consumer sentiment has been weakening, the latest jobs report from the BLS showed that our economy remains relatively stable. Total non-farm payroll employment increased by 177,000 in April. This was higher than what many economists had projected, and the unemployment rate was unchanged at 4.2%. 2. Despite ongoing tensions, President Trump has stated that he had no intention of firing Fed Chair Powell, which was exactly the message markets have been hoping for. Plus, reinforcing the first point, we would think that this public announcement strengthens Powell's approach to wait for more clarity and direction before starting to lower rates. So another reason not to expect any fast or deep rate cuts. And 3. The Trump administration has recently softened its overall tone and stance on tariffs and suggested that progress is being made on negotiations with key trade partners. Again, something that has been settling the markets. So taken together, these three factors appear to have brought some much appreciated calm and moderate optimism back into the markets after a fairly volatile and uncertain month. But make no mistake, these factors are all very much tactical in nature, meaning nothing's been really fixed in a fundamental way, at least not in our opinion. So it wouldn't surprise us if we saw a few more ups and downs in the markets in the coming weeks and months, especially given how busy the Trump administration seems to be. As always, we'll keep our eyes and ears close to things and update everyone here in our Diamond NestEgg community. And we've already penciled in Chair Jerome Powell's next press conference on monetary policy on May 7th, after the Fed concludes its two-day policy meeting. So that should be exciting. For now, though, let's move on to the next section of today's video. Which treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, Let's grab our rates from the Treasury's daily Treasury par yield curve rates page and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the ends of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. The 1.5 month and the 2 month were down this week by a basis point or two. Treasury yields across all other maturities were up, though, with the biggest increases to be seen in the 4 month and the 2 year, both of which were up by 9 basis points. The 1 year closed the week back up at exactly 4% again, but let's see if things will stay this way in the coming weeks. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. The 4 month and the 6 month are the only maturities that are higher than where they started the year, with the 6 month clinging on by just a tiny 1 basis point increase. The 30 year is unchanged. All the other maturities are down since the beginning of 2025, with the most significant downward moves still to be seen on the 2 through 7 year maturities. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker or when you sell will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of today's video. What are the expected yields on the upcoming week's Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill auctions are happening as usual. The 3-year T-note, the 10-year T-note, and the 30-year T-bond will be auctioned off as well this upcoming week. None of these are reopening auctions, so the coupons are still to be determined on auction day. At the time of this taping on Fidelity's platform, here's what the coupon and the expected yield are for the 3-year T-note auction. And here's what the coupon and the expected yield are for the 10-year T-note auction. And here's what the coupon and the expected yield are for the 30-year T-bond auction. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries. For those of you who may be interested in other types of bonds and CDs, on Fidelity's platform currently, the highest yielding new issue agency bond is from Federal Home Loan Banks at 6%, with a maturity date in May 2055 and a first call date in August 2025. The CUSIP is 3130B6B54 for those of you who may be interested. And the highest yielding new issue corporate bond is from Dow Chemical Company at 6.55%, with a maturity date also in May 2055 and a first call date in November 2025. The CUSIP is 26054MHN4 for this one. For brokered CDs, the highest yielding one is from CFG Community Bank at 4.5%, with a maturity date in May 2033 and a first call date in August 2025. And as promised in the beginning of this video, for those of you watching this in North Carolina, LGF Credit Union is offering an 18-month share term certificate with a 5.5% APY. There is a $250 minimum deposit required. There are membership requirements as well, as is typical for most credit unions. So I've linked their website in the first pinned comment below for you in case you want to check out this offer while it lasts. Many thanks to Diamond NestEgg Super Saver David for sending this our way so that we could share it with all the North Carolina folks here. As always, if you know of any bank CDs or checking and savings accounts with particularly attractive rates at the moment, then please do drop them below and let me and the community know. All right, members, Super Savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about bond investing and building a bond portfolio, then check out this video here on our bond courses. And come join our next live member Q&A on Thursday, May 22nd at 7 p.m. Eastern Time, 4 p.m. Pacific Time. We'll be diving deeper into the 2, 5, and 7-year T-note auctions this month and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.